My name is Wayne Williams, and I'm the Department Chair of Business Administration here at the Community College of Philadelphia, your path to possibilities. Let's talk taxes. Smiling and talking taxes don't go together, but today I'm going to smile while I try to describe to you some of the effects of fiscal policy and taxes that we pay, you and I. Over the past couple of years, I've come to you to talk about different issues that have faced the economy here in the United States. When I first started, the issue that we really talked about was banks. There was a credit freeze, and there was a need for the United States government to stimulate the policy by doing a bank bailout. Shortly thereafter, one of the largest industries here in the United States, the automobile industry, faced bankruptcy. Once again, the United States government had to intervene, and they intervened by providing the automobile industry with another bailout. After that, we turned our attention to the rising rate of unemployment. We faced staggering rates of unemployment. It reached double digits throughout the country. Lots of people got laid off, and we entered into a recession. All of these factors we've covered over the past couple of years, and today we're going to talk about what's on the minds of a lot of people, income taxes. So, the money that we have in our economy gets taxed. We're going to look at policy and how taxes are applied to the money that gets produced in our economy. Now that we face a historic deficit, our elected representatives in Washington are engaged in what we would call political gridlock. Many of us have returned back to school, and enrollment here at the community college has even increased. Enrollment throughout colleges across the country have increased at the same time. We're working hard to educate and retrain a skilled workforce to enter back in the economy so that we can grow the economy. Like most public institutions, even us here at the college have faced some budget cuts. Well, budget cuts are also a talk and a policy that the United States government needs to have. Should we increase taxes or decrease taxes? Do we need to expand spending or decrease spending? That's going to be the focus of our discussion today. You can't turn on the television without hearing taxes. There are those who believe that raising taxes will actually hurt our economy. As a matter of fact, Americans for Tax Reform have pledged that they will not raise taxes. This legislation or pledge is not a part of legislation, but it's a pledge of 238 congressmen and 41 senators. They have vowed not to raise taxes on individuals or raise taxes on corporations. But does this make good economic sense? Does the pledge mean that lower taxes will stimulate the economy? In the meantime, we've experienced Occupy Wall Street. Occupy Wall Street is even here in Philadelphia, and they have said there should be a tax imposed on the wealthiest of Americans. Does that increase in tax on the wealthiest make sense? Is it good economics? Today, we're going to take a look at fiscal policy. For sure, we will not solve all the complex fiscal policy issues that the nation faces, but if it were that easy, it would have been done already. So, one goal of learning about economics is to make us informed citizens. So, let's take a look at the overarching theory of fiscal policy and the competing arguments that are derived from those policies. Fiscal policy. When we think about fiscal policy, we're talking about changes in government expenditures. And in this case, when we talk about government expenditures, we're talking about spending. So the word expenditure actually means spending. Another element of fiscal policy is change in taxes. So the argument that we're having in Congress is talking about changes in government spending and changes changes in taxes, excuse me. There is a reason that this fiscal policy is important. Number one, it produces economic goals. For instance, these policies can produce low unemployment. Low unemployment is an economic goal. Something else that good fiscal policy does is it creates stable prices. And thirdly, one of the goals of economics is always going to be growth. So good fiscal policy will produce three things: low unemployment, stable prices, and growth. How do we achieve good fiscal policy? There are two different approaches to fiscal policy, and I'm going to show you a slide that compares the two. On the first side of the slide, on the left, you will see the Keynesian theory, where it says that the economy is inherently unstable, and therefore government will need to intervene to stabilize the economy. On the opposite side, you see the classical theory. Classical theorists believe that the free market system is self-correcting, and it functions best when there's no government intervention. Clearly, there are two different philosophies. Another aspect of Keynesian theory is government spending will actually provide companies with contracts. Those contracts will allow them to hire workers, and that will increase the receipts of government business through taxes. It also will increase the number of employees, thereby expanding the tax base. All of that will lead to an increase in economic growth. The classical theorists disagree with this. They suggest that government spending will require increased tax burdens on corporate entities, and so when corporations have higher taxes, they're going to hire less people. That's going to lead to slower economic growth, and it's also going to lead to sending jobs overseas. As you can see, they are contrary. The last aspect of Keynesian theory says that government should invest in the infrastructure of the economy, and by investing in infrastructure, that will lead to job creation. Investments include things like education, the development of roads and bridges, and construction. On the other hand, the classical theorists believe that government investment crowds out private businesses. By crowding out, what I mean is instead of government providing these services, private businesses could do the same thing. So it means that there are private schools, there are construction companies that will provide the same level of jobs without the same level of government spending. So in this role, we can go back and look at fiscal policy and see that an argument of changes in the amount of spending done by the government is an important aspect to changing how our economy will grow. Given the two different approaches, we should take a look at the theory behind how expansionary fiscal policy works. So I'm going to take you over to this diagram. In economics, we often use diagrams in order to express visually how the economy works. So this is expansionary fiscal policy. Expansionary fiscal policy is a mechanism that is used by economists during recessionary periods. So when the economy slows, our goal is to expand the economy, thereby increasing the tax base, and we will grow the economy through increased spending from consumers. On the vertical axis, what we have is the price level, and on the horizontal axis, what we have is GDP. You will see LRAS, and that stands for the long run aggregate supply. The long run aggregate supply is what happens to the economy in the long run as a result of expansionary policy. You also see SRAS, and that is what happens to our economy in the short run. So GDP measures growth in the economy. Ultimately, if we were to start out at Q1, representing this point right here, this is where the economy currently is hypothetically. Our goal through expansionary policy will be to shift the curve of aggregate demand. Aggregate demand, as we've talked about in the past, means consumers going out and spending money. In order to get consumers to spend more money, we want to shift this curve. Ultimately, if we are successful in enacting good expansionary policy, you're going to see a shift in the aggregate demand curve from aggregate demand curve 0.1 over to aggregate demand curve 2. This shift rightward in the aggregate demand represents expansion of the economy. The theory behind expansionary policy is to increase government spending. So by increasing government spending, we're stimulating the economy, and that is one way to shift the aggregate demand curve. Another way to shift the aggregate demand curve is by decreasing taxes. So let's look at this. If we want to actually stimulate the economy, according to expansionary policy during a recession, there are two things that we need to do. One is increase spending by the government, and two is decrease the amount of taxes. Now, based upon the political dialogue that we've heard, these two things represent the two parties and their philosophy. Here, it looks like the Democrats are saying we should increase spending. Ways that the Democratic Party has talked about increasing spending is through infrastructure, is through education and funding policies that will help to stimulate the economy. However, the pledge says that, guess what? We should not do it at the expense of taxes. So the Republicans say, how are you going to pay for this? Well, the issue that we face today is while we're trying to stimulate the economy, we're also trying to control the deficit. So this gives us contrary goals. We're trying to increase growth in the economy, while at the same time that we're increasing growth in the economy, we're also trying to decrease the federal government deficit. We've talked about both GDP in the past, and we've also talked about the deficit. The deficit is when government revenues are less than the government spending. Under our current situation, the government takes in less money than it is spending. So, to control the deficit, you'd either have to increase the amount of revenues that the government collected or decrease the amount that it spends. That would run contrary to economic growth. So you can see the economic quandary that has been created in the current economy here in the United States. Let's look at our U.S. tax structure. There are some criteria for evaluating an effective tax structure. According to the AICPA, which stands for the American Institute of Certified Public Accountants, it suggests that a tax system should be simple, that it should be neutral in terms of the effects that it has on business. The tax system should be clear and should be readily understandable. It should be structured to minimize the amount of non-compliance. In other words, it should be structured so that people will actually know how to file their taxes and do it voluntarily. It should also enable the IRS to predict the amount of taxes that will be collected and the timing of when those taxes will be collected to help the government with its spending. The other issue that the American Institute of CPA suggests, and probably one of the more important aspects of their recommendations, is that it should not reduce economic growth. So a tax policy should not reduce economic growth. Well, let's look at this next slide, which is going to show the three ways that you can tax in a tax structure. I'm also going to produce our current tax structure here on Wayne's Wall. If you're looking at the slide, what you're going to see is that there are three ways to show the tax structure. We can have a progressive tax structure, a flat tax, or a regressive tax. Federal taxes in the United States are progressive. Let's take a little bit of time to understand what a progressive tax system is. Essentially, what it means is the more you make, the more taxes that you pay. And when we say you pay more taxes, what we mean is that the percentage of tax on an individual increases as their income goes up. So a lot of times it looks like a ladder. The more you make, the more taxes you pay. Now, over history, what we've seen is we've made some changes to this ladder, and the effect of the changes to the ladder means we're not real sure who's paying more and who's paying into the system. Our federal tax system is progressive, so argumentably, the more you make, the more you're going to pay. If you're looking at our state tax system here in the state of Pennsylvania, we have, what you saw on the slide, a flat tax. The flat tax system says no matter how much money you make, everybody pays the same percentage. So here in Pennsylvania, we pay a flat tax. And so literally, instead of the stair step, everybody pays exactly the same. Which one makes sense? Well, that makes taxes even more complicated when you talk about the best way to tax. Our federal tax system has been a progressive tax system since it started. Basically, what we say is those individuals who have a higher income can afford to pay more. But what exactly does that mean? Paying more means that you have to take into consideration the concept of disposable income. Currently, in our system, the top tax rate is 35%. So, we need to first identify what we mean by disposable income. By disposable income, we're talking about the amount of money that a person takes after they take into consideration all of their income for the year, and then they take out their taxes. This formula will represent your disposable income. Disposable income is important because not everyone has the same level of disposable income. If you're a higher income individual, even if you're paying a significant more in the amount of tax, because of the percentage of tax, you actually may have more disposable income. The lower your income goes, the more of a bite the income taxes take out of your paycheck. And after you pay your bills, you have less disposable income. So it makes an argument for maintaining lower taxes on individuals who have lower income. How does that lower tax on the lower income show up in the economy? Can't talk about economics without looking at the flow of economic growth and how resources flow through the economy. So we're going to go back to a chart that we always use, which shows the relationship between households, the government, and businesses. Households go out to the resource market and they go and get jobs. They take skills into the resource market where human resources by businesses hire them. Those skills are then given to businesses. When the business provides the job, it sends back income to households. Households have income and therefore pay taxes to the government. When businesses use the skilled labor, they also produce products. And so products are produced by businesses and they are consumed by households. When households consume the products, they receive the products, the businesses receive revenue, and that revenue gets taxed by the business. Businesses also pay taxes to the government. So when we talk about taxes, we have to distinguish who's paying taxes. Are we talking about households paying taxes, or are we talking about businesses paying taxes? Ultimately, the government collects those taxes, and our economy right now, the combination of these two taxes are less than the government is actually spending. So, how do we resolve this issue? Again, we would have to increase the amount of taxes imposed on businesses and households or decrease government spending. But remember, that philosophy will run counter to economic growth. So it's a balancing act between the two. The next slide I'd like to show you will show you what the federal budget receipts looks like in 2011. So in other words, in this diagram, who pays what into the government for taxes? 44% of government receipts are paid by households, compared to 12% by corporations. The second largest aspect of taxes are shared between both households and businesses, and it's Social Security. Social Security pays in 36% of government collection, and it comes from both households and from government. So if we look at where the majority of taxes come from, the majority of taxes that the government collects comes from 44% from household, 36% contribution from both households and businesses, and corporations, which pay corporate income taxes of 12%. If we increase taxes for businesses, what will happen is it will lead to less jobs. If we increase taxes to households, what will happen is it will reduce the amount of disposable income and curtail spending in the economy. So, if we decrease the amount of taxes that businesses pay, businesses will hire more workers. And if we decrease the amount of taxes that households pay, consumers will spend more money in the economy. So ultimately, from a theoretical perspective, decreases in taxes to both businesses and households will lead to increased spending and higher hiring rates in the economy. The obstacle is if government spending remains the same, then it also creates a deficit. Hopefully you're not confused by the scenario, because you should be. There are contrary themes that I just went over. To revisit them, let me slow down just a little bit and go back. In order to move our economy and grow it, one way to do it is to increase government spending and to reduce taxes. That will grow the economy. However, that approach will also create a deficit. So, to control the deficit and grow the economy at the same time, looking at expansionary fiscal policy, there must be a balancing act between the two. So, should there be a combination of tax increases and decreases in government spending? Probably so. In order for us to take a better look at it, we should look at who is paying the taxes in our economy, and we should also look at just what tax are you talking about. When you speak about taxes, you can't use it singularly. There are taxes on just about everything in our economy. So it makes it complicated. One argument that is used is that taxing business owners would be bad for the economy. So let's look at how a business pays taxes. A person who goes into business starts a business. By starting a business, what they do is they create an entity, represented by this diagram. This entity, we'll call it ABC Company. An ABC Company has an owner, and we'll call him Joe. ABC Company hires workers, which is good for our economy. What it does is it expands the tax base. When ABC makes a profit, the profit gets taxed. Currently in our system, the maximum tax rate on profits is 35%. We have some of the highest corporate income taxes in the world. However, this 35% tax rate is also a progressive tax rate, and you only pay 85% when your business profits by more than $18.3 million. So smaller businesses like the ones in our neighborhood do not pay a tax rate of 35%. That 35% rate that is stated in the dialogue that we hear on television represents companies whose corporate tax profits exceed $18.3 million. Any income or profit that they make that's less than that pays less than 35%. Well, this entity has a business owner, and his name is Joe. Unlike you and I, who get taxed on our income from a job, Joe, he gets taxed in the form of dividends. As a business owner, he's the majority stock owner, and most of his income comes from dividends, not from salary. So, how do dividends get taxed by business owners? Prior to the Bush tax cuts, dividends were taxed as ordinary income. But since the Bush tax cuts, one of the more controversial tax changes was that dividends were no longer taxed as ordinary income. Instead, they received a special treatment called capital gains. Now, unlike your income and my income, which is ordinary, capital gains have a maximum tax rate of 15%. So a person who derives the majority of their income from dividends actually pays less taxes. So if we were to hear someone like Warren Buffett say, I actually pay less taxes than my secretary, what he's referring to is the fact that he pays capital gains tax on his income, where his secretary pays ordinary income taxes. Ordinary income taxes actually are higher. How much higher? Let's take a look. How does an individual versus a business get taxed? Since we have a progressive tax system, and since we make tax changes every year, it can get very complex. What I did is I looked over the past 20 years and I said, what's happening with taxes and the tax rate? And I took a snapshot for every 10 years. We're now in 2011, so I looked at 2001 and I looked at 1991. In 1991, the top rate was 31%. 31% meant that your income for a person who was married filing joint was $135,360. $366 actually. So any person who had income in 1991, and mind you, this is adjusted for inflation, so this is in today's dollars. any person making over $135,000 would be paying 31%. Let's compare that to 2001. In 2001, the top rate was 39.6%. This rate was imposed by President Clinton and had been in place up until the tax cuts that were imposed by President Bush. And this 39.6% tax rate was imposed on married filing joint who had income that was $381,351. That's a significant difference in income. And it's also complex to follow. In other words, any person making over $135,000 was paying 31%. We increased the rate, but we also increased the income. So a person making $135,366 in 2001 wasn't in the top tax bracket, but they also were probably still paying about the same amount. So what we did is we increased the amount on those making over $381,000. So where are we today? Today, we've decreased the tax rate for top earners, and it's gone back down to a top rate of 35%. But the amount of income for that has actually declined slightly. So the top income amount for a person making over $372,950 would be in the 35% tax bracket. Somebody asked me, who is the top 1%? And how much do they make? And I thought that was a good question. The top 1% in the United States right now, according to the Wall Street Journal, makes approximately $506,000 in income annually. So that would put them in the top tax rate. Had it been 10 years ago, that tax rate or the taxes that they would pay would be increased by about 4.6%. If we were to look at the tax rate on an individual making $506,000 under the old regime in 2001, that 5% increase would impose on the $506,000 an additional tax of approximately $25,000, which would reduce their income by that amount. So is the amount $25,000 of additional tax too much for the top 1%? I don't know. It's up for subject for debate. And we see it in Occupy Wall Street, who says that these individuals can most afford to contribute more to our tax revenues. Now I'd like to turn your attention to, who pays into the government what proportion of taxes. So if we're going to talk about the top 1%, we should talk about what is their contribution to the revenue that the federal government collects. Looking at the top 1% of individuals in our current economy, the top 1% actually take in 21.2% of all income go to the top 1%. Now, one of the things that happens when you use percentages is it gets a little bit confusing. So, what is all the income in the United States? Let's identify that as approximately $13 trillion. So, of that $13 trillion, if they're taking in about 1/5 of that, we're looking at the top 1% equals about, quick math on that would be 20% of 13 or about $2.6 trillion of income. So the argument is they get the vast majority of income. But what about the top 10%? If we look at the top 10% of individuals in the United States, the figure gets even more staggering because the top 10% actually take in almost half of all the income, or 46.44%. So what that means is the top 10% of the United States actually earns almost half of all the income in the United States. Because the burden on the top 1% is highest for their earnings, we should look at how much they actually contribute. 40% of all taxes collected are paid by the top 1%. So you can imagine they're contributing 40% of all the federal revenue that is collected by the government. Just this top 1%. If we have 300 million people, we're talking about 3 million people pay 40% of the government's revenues. And as you can see, that creates quite an argument in our political discourse. So, how do we look at the tax rate, the tax base, and the tax revenues? I'll try to make it simple by giving you a quick formula. The formula that is used by economists to determine whether or not tax policy is effective is a look at the marginal tax rate and what happens to the tax base. So, setting up the chart, looking at the tax rate, if we just used it on average. If the tax rate is 20% on average, what impact would that 20% tax rate have if we enacted certain policies in our economy? If we started out with tax rate of 20% and we had a tax base, meaning the people who pay into the taxes, of $100, just to make it simple, the formula that we would use is the tax rate times the tax base would equal our tax revenue. So, what we would do is we would take the tax rate of 20%, multiply it times the $100, which represents the tax base, and we will come out with tax revenues collected of $20. That would be our starting point. In the scenario, what we would want to do is see, well, what happens if we drop taxes down? What would be the effect? So instead of using 20% this time, let's drop taxes. Everybody loves tax cuts, right? So if we decrease the tax rate from 20% down to 15%, and we looked at the impact of the tax base, there would be more people hired, more people working, and more people paying in. The tax base would now be $120. Okay, what would be the impact of that? If we did the math, 15% of 20 equals 18. We decreased taxes here, but it was ineffective because the amount of revenue that was collected is actually less. So we don't want to decrease taxes that results in a decrease in revenue. What we want to do is decrease taxes so that we increase the revenue. So let's try it with some more numbers. Let's assume that we decrease taxes again from our starting point of 20% and move down to the same 15%. Well, in this case, let's take our tax base and make it 150. When we move our tax base to 150 people paying into there and increase that tax base, and we do, again, a little bit of quick math, we'll come up with 22.5. Now, in this scenario, what we've done is we've decreased taxes, but the impact has been an increase in revenue. The 22.5 is more than the 20 that we initially collected when we started out. This would be good tax policy. If we could decrease taxes that results in a tax base that would increase tax revenue, that would be good economic policy. So, how do you make that work? Decreasing tax rates actually work when the tax base, more people are hired. In other words, when we decrease taxes, we need to hire more people. We have seen decreased taxes remain in place over the past year. We have not increased taxes. However, the number of people hired has not increased dramatically. The unemployment rate has gone down, but not dramatic enough. So the argument is this tax rate decrease resulting in increased revenue? And so far to date, that's questionable. As a matter of fact, it hasn't really helped spur the economy. I'd like to show you a chart that reflects basically what has happened over the past 10 years with regard to the amount of revenues that were collected by the federal government. Federal government from the period 2000 to 2010 has, through the Bush tax cut era, has actually had a decrease in the amount of revenue that has been collected by individuals. So in 2000, looking at the chart, it shows that the revenues collected were over $1 trillion, 1,004,462. You get big numbers like this, it's hard to remember them all off the top of your head. Now, in 2010, looking back, the total revenue collected from individuals is $898,549 billion. So if we look from 2010, tax revenues collected from individuals has actually gone down as a result of tax cuts. If we look at corporations, we see kind of the same trend. Basically, corporations have contributed 207 billion actually, 289 million of tax revenues through 2000. And then now they have contributed in 2010, 191,437 million in tax revenue. The decrease in both years can be reflected through percentages. Tax revenues collected by individuals is down 11%. Tax revenues from individuals is from corporations is down 8%. So what we're seeing is a decrease in the revenue. Overall, however, revenue is up, and there's a reason why. The reason why revenue is actually up is because there has been an increase in the amount of taxes collected for Social Security. Now, how do we pay Social Security taxes? In the past, I've shown you by giving you a diagram of maybe what your paycheck would look like. And so we probably need to take a look at something like that now. Most everyone who has income in the United States pays into Social Security through Social Security taxes that are withheld from their income. However, if you remember, I talked about dividends not being taxed as ordinary income, but they're being taxed as capital gains. So people who derive their income from capital gains don't necessarily have to pay into Social Security. In addition to that factor, there's another factor that we should take into consideration, which is Social Security taxes are paid by your employer and also by the employee. Now, in 2011, we've looked at this in the past. The number of individuals that are going to collect Social Security, just based on those individuals turning 65 because of the baby boomers, is expected to increase. The employer has to pay 6.2%, and the employee has to pay 6.2% of earnings. You see this come out of your check, and you go, why I have to pay that? Well, you're paying into the Social Security system. It's matched by your employer. But there's a caveat to this approach. Currently, If you make over $106,800, you do not have to pay into Social Security for every dollar that you make beyond $106,800. So any individual that makes above this amount of income stops paying into Social Security. So an individual that makes less than this pays Social Security tax on all of their income, but a person who makes more than this doesn't pay any Social Security income tax beyond that threshold. So again, when you hear the argument that says that the wealthier pay less taxes, one caveat to it is the way that our tax system works for Social Security. Currently in the threshold for Social Security is $106,800. Is it even? No. Should it be? That's up to us as voters to decide. We have to take into consideration how we spend the money as a government. So I'm going to show you another slide that talks about where the government spends money. This slide shows the outlay in 2010. The vast majority of our money goes to spending for defense. Looking at the pie chart, you could see that that represents 19% of all revenue that comes into the federal government goes to spending for defense. The second largest part of our spending is non-discretionary spending. What is non-discretionary spending? Non-discretionary spending are things that we have the ability to look at, like education or something like that. And our non-discretionary spending is up 18%. It gives us the ability to go into our government and shrink it. And there's a lot of pressure for us to, this is non-defense discretionary, shrink the amount of money that we're spending for non-defense discretionary. The next one is Social Security. We spend almost as much money on defense as we do on Social Security. So in economics terms, we call defense guns, and these we call butter. And so the dialogue is about, what do we need to cut, the guns or the butter? The non-defense discretionary spending are things like education, social programs. And there are many who say we spend too much money on programs that are ineffective. Maybe we should look at some of those programs. The third or the fourth largest segment is Medicare. Medicare spending represents almost 13% of the spending by the federal government. And so these four sectors represent the majority of the spending that happens in our government. As you can see, it is quite a quandary. We have to take into consideration the amount of taxes that both households and corporations have to pay. In addition, we have to balance that with the amount that government spends. Ultimately, in order for us to grow our economy, we have to go back to expansionary policy. Looking at expansionary policy, our goal will be to move the aggregate demand in the economy by shifting the aggregate demand. And we can do this by increasing government spending or reducing taxes or a combination of the two. Currently, there's no tax increases on the right and increased spending on the left. The political gridlock has led to a debt crisis. The political gridlock has led to an increasing deficit. The political gridlock has led to a lower debt rating for the United States of America. Ultimately, those who we've elected in Washington have to come to some sort of compromise. Not only are they taking into risk the economic growth of the nation, but also the future economic growth of the nation. Future economic growth is represented by the long-run aggregate supply. If we do not move the aggregate demand in the economy, what we risk is not achieving the long-run aggregate supply. I know you may have more questions, and I'm going to answer some more of those questions the next time that you get a chance to tune in. I really appreciate you spending the time today. I hope I have helped you to understand the tax structure here in the United States and take a look at the fiscal policy of our government. It's been a pleasure spending this time with you today. Again, my name is Wayne Williams, and we here at the Community College of Philadelphia represent your path to possibilities. Remember, our economy works when you do. Thank you.